Hey, what's up, my friend? So I'm excited, right? Because today we have Peter Brandt on the show, right? So Peter has been trading for the last 50 years. Well, 49 years to be exact. But, this is, I think it's definitely his trading career is older than I am. And I'm pretty sure it's older than many of the viewers and listeners who are tuning in right now. Okay? So, and also something to share with you is that I have two grandfathers. Okay, one of my grandfather passed away before I was born, and the other grandfather passed away when I was about 10 years old, if I recall. So when I spoke to Peter on the show, it felt like, man, this is like speaking to my grandfather, whom I never had, right? I never get to experience before. So it was heartwarming, it was enlightening, and it was inspiring. So if you want to connect with Peter, I will put his social media profile in the description below. But moving on, right? Here's what my conversation with Peter is about. Number one, we spoke about what it was like, right, to be living, just after World War II, right? He shared about, his experiences, his story as a kid, the jobs that he did back then. Then, of course, we talked about how he got started in trading, why he's such a huge advocate of classical chart patterns. He shared about his favorite chart patterns and the ones that he would avoid. He dived deep right into the entries, the stop loss, the targets, and where you would really find, I would say, a ton of golden nuggets is how he managed his trades from start to finish. He actually break down step by step to after his entry, right? When does he set his trade to break even, all right? And how he manages the trade as the price is moving towards his target. What if he reverse right near his target, right? How does he then handle such situations? So you can see that a lot of the nitty-gritty details that, you probably won't find this in books, right? He actually covered, right, during our conversation. I find it so powerful because this concept can be applied not just to people who trade chart patterns, but, day traders, price action trader or whatsoever, right? So all this and more in today's conversation. Go listen to it right now. First and foremost, right, Peter, I just want to say that outside of trading, I've been following you on Twitter for a while now, and I really respect that you are not afraid to speak up on what's on your mind. You're someone who dares to stand up on what you believe in, right? Because sometimes I see, comments, trolling you, and I know personally I get those myself, and I know it's not easy for me personally taking it. So I feel that you're doing a way better job than me. Maybe from the wisdom and experience over the years, you can kind of like take them a lot more easier on your stride. So I really respect that, and I have to learn a lot from you in that regard. Amazing stuff, man. Gave me, the strength to know that, sometimes, people are not too kind. I look, hey, if I were Peter Brandt at this point in time, right, what would his state of mind be like? And I kind of like feel comforted. He probably, tell him to, screw off and life goes on, right? Enjoy the mountains and whatnot.
We get trolled. I mean, I think my parents did a good job at teaching me you're not going to make everybody in the world happy. You're not going to make anybody in the world happy all of the time. So, you've got to be honest to yourself. You've got to know what you're thinking. You've got to be willing to share what's on your mind, even though you know that there are going to be times when people agree and approve of what you say, and there's going to be times in which people just find what you say to be horrible. And I commented today. Somebody tweeted me and said, "Peter, I sure wish you would just stop commenting all of these political, social, environmental, global issues and just focus on your charts." And my response back is, I'm a stakeholder in my trades, but I'm also a stakeholder in life. I have children, I have grandchildren, I have a wife, I have a community in which I live, I have a country in which I live. I'm a stakeholder in those things. I have a stake in things that are taking place in the city about me, the state about me, the country about me, the hemisphere I'm in, and the world I'm in. And these things matter to me deeply. I just think that it's important for me, not that I'm going to win anybody over to my way of thinking, but it's important for me to be able to express how I feel, whether there's somebody out there that's listening or likes it or not. It's important for me to at least lay claims to the belief system that I have.
Yes, I totally can see where you're coming from. That maybe earlier you talked about how your parents, since young, talk about how you should stand up for what you believe in. So I'm curious, right? Because I think this is something that I've not heard, at least on the other podcasts. In one sentence or one to two sentences, how would you describe your childhood?
I was forced to be independent from a very early age.
Why is that?
Well, I had parents who divorced. I was raised by a single mother on welfare. We were welfare children. And we had, enough to live on from month to month and week to week, sometimes from day to day. And while money doesn't bring you happiness or sadness, it's a reality of life. And so, from early on, if I wanted to buy better clothes than I had, that came from the local used clothing store, uh, I had to earn the money myself. And so, really, I've been pretty much self sufficient, ever since I was 12 years old. So,
Wow.
I know what hard work looks like. I know what it looks like to really be dependent upon yourself. And so I think coming along with the baggage that my parents had was they were dealing with so much stuff. We really kind of raised our kids, really kind of raised ourselves in some ways, right? I mean, we had to kind of find our own path in life. Sure, we had parents who from time to time would speak into our lives and provide us with advice or guidance or restrictions or limits, but an awful lot of the business of day-to-day life for me from really preteens on was of my own creation, and of my own finding. I mean, the reality is when you're young, your reality is what you have, right? It's not somebody else's reality. It's reality of what you're going through in your own life. And so that was my reality. So I didn't have any sense to say, well, I wish it would have been different, or I wish I would have had this or I had that, because I had what I had. But I think the reality is it made me to be a hard worker, and I learned to solve problems early on, which really is a great segue into trading, right? Because trading is basically a never ending process of solving the next problem that's in line. And so I think that from the life that I came out of as a younger person, I think equipped me to do what I've done uh, now for 50 years. I made my first futures trade in 1974, and and quit my day job and went on the board of trade exchange in 1975, but actually made my first trade in 1974. So that's 50 years ago. So a lot of lessons that I had to learn when I was growing up were lessons that I think I put to good use as a market speculator.
So I'm curious. You mentioned you started being self-sufficient at age 12. So what was your first job, right? Curious to know.
Boy, I did a lot. I mean, it was this was back, in the 1950s, really, where you had corner grocery stores. Everybody had their corner grocery store. You had your corner meat market, you had your corner laundry, you had your corner gas station. And so, life was much more community based, I think, in the America that I grew up in. I would hand out flyers. And so the local grocery store would have a weekend special on steak, and so or on cans of soup, and they would print it all up in a flyer that would announce their special sale. And I would get a big handful and I'd walk door to door and I'd fold them and put them in people's mailboxes. And or I would collect newspapers. Back then I think we did a lot more recycling, and so I would let neighbors know that rather than throw your newspapers away, put them in a pile and I will come and get them. And I'll come and get them with my wagon. And I would get these newspapers and I would tie them up with string and I would sell them to the recycler. Or I would collect metal hangers. We were just back then coming out of, within 10, 15 years of World War II. So America was still relatively frugal on raw materials. It's not like today where we have a disposable world. And so collect metal clothes hangers and bring them back and give them to the dry cleaners. And so the dry cleaners didn't have to keep buying new white metal hangers for your laundered shirts. They could use the metal hangers that I would sell to them, or pop bottles or tin. This was pre-tin can. I mean, I'm old enough that I remember when we didn't have aluminum cans. Aluminum cans, that was kind of one of the greatest inventions of my lifetime. But we all had bottles that were glass bottles, and usually these glass bottles, you'd buy a bottle of Coke, and it would be an 8-ounce bottle, and it would have a metal can top that you'd take out, but there would be a 1 or 2 cent return deposit on the bottle. And so I could collect these bottles and return them to a grocery store for a couple of cents. And so it was just a matter of collecting a few bottles and bring them back and get my money and turn around and give it back to the store in exchange for the candy that I wanted to eat. So yeah, it was a whole line of things that I would kind of figure out as a kid that, hey, I can make a little bit of money doing this. And then eventually when I became a little bit older, it was delivering copies of the city newspaper, the Minneapolis Star and Tribune. Star Tribune is what the newspaper is still called to this day. Would have the morning paper. And so I had a paper route, and I would go around, and this was pre-internet. Now you read your newspapers on the internet, of course. But this was back when people got physical copies of newspapers, just as they do with some newspapers today, the Wall Street Journal. And so I had about 150 newspapers that I would deliver each day. And so I'd go down to the local distribution area for my zip code, although we didn't have zip codes back then, for my neighborhood, and load up 150 newspapers on my wagon or my bicycle. And if the weather was right, and I'd go out and I'd deliver them door to door people. And then every month I'd go around and I'd collect money for the newspaper. And in effect, was a commissioned newspaper salesman, except I actually had to deliver the newspaper. But of course, when they were done with them, that's when I'd always say, don't throw these newspapers away. After I deliver them, read them, and then keep them, because I'll be back for them. And so I'll get money on the front end, and I'll get money on the tail end of these newspapers.
So, when you were 12 years old, starting, doing such odd jobs, right? Is it like, when you get such job opportunities, is it like just all around you, or is like a lot of your friends are already doing such things as well?
No, I mean, some of these things, of course, people brought to my attention, such as newspapers. I mean, newspapers had been delivered by newspaper boys long before I became a newspaper boy, is what they called me, newspaper route salesman. So that was just a matter of knowing those jobs were there and that there was money attached to them. But things like delivering flyers for the local store, I mean, a lot of these things were kind of things that entrepreneurially I made proposals. And so sure, there are some of these things other people had figured out that there was a way to make money, but and so I didn't get an allowance like we pay kids today an allowance. We give them a weekly or monthly stipend for school lunch and so forth. But just some of these things were entrepreneurially created by my own creativity and ability to go out and talk to adults and say, hey, I've got a business proposal for you.
Wow, that's amazing. It's something that I rarely hear of these days and age anymore. All the kids, they kind of have it easy, right? Allowance, meals are provided for, life is good, right? And I guess the downside is it kind of like, it doesn't inspire or give them the hunger, the drive to go out there and get shit done. Yeah.
Absolutely. I mean, and part of that is just the age we live in, right? I mean, the world changes. We can't expect the world to stay the same. We have to be willing to be flexible enough to adjust to changes that they come about in our life. But I don't see the same motivation, for instance, my grandchildren. I have 5 grandchildren, and I don't see the same motivation in my grandchildren as I saw in my own children, and definitely as much as I saw or experienced by myself or saw in my sisters, who also had to do odd jobs, babysitting or sewing clothes or whatnot. I think that to some degree, kids that are being raised today have a free pass that we did not have. Uh, I think there's good and bad in that. I mean, there's good in that if kids use their free time and ability and not having to go out and work for their own school food or clothes, they can use it to apply themselves for learning. Uh, but there, even again, I think a lot of these kids use their spare time to play iPad and be involved in watching YouTube videos. Not to not promote you. I'm not trying to take your audience away from you, Rayner, because I know you do a great job educating. But I think there's always opportunities for young people today that are willing to learn and willing to find things that they fail at in order to find things that they can succeed with. And so, to some degree, along with maybe having it a little bit easier, I think one of the disadvantages young people have today is they don't cope with failure well. They're used to success. We had to earn our grades. There were no free A's in school when I went to school. We had to earn our A's, where now we live in an age where there's trophies for participation. All you have to do is participate in the sport and you get a trophy. Back then you had to actually earn the trophy, and there were a lot of teams that went home from tournaments disappointed without trophies or some sort of piece of paper to frame. And so we'll have to see. Each generation hands the baton to the next generation, right? And we've handed the baton to our kids, and I think they've done a wonderful job. But now their kids are just coming of age, and we'll see how the baton is handed off with the next generation.
Right. And I'm also, because this is not something that I can experience. So at your age, right, maybe back then when you were 12 or 13 years old, could you maybe just, if you remember, right, could you maybe just walk me through a day in your life at that age where you have to juggle with your studies as well as, your entrepreneurial drive and the things that you're doing outside of school? What's a day in a life like
Yeah.
of Peter Brandt at 12, 13 years old?
Yeah, I mean, get up and get dressed and go get the newspapers to deliver, right?
What time are we talking about?
Oh, five in the morning. Yeah, 5 in the morning. Go get newspapers, deliver the newspapers, get home, have cereal. My mom, with the age of Wheaties and oatmeal and fruit and milk and a banana, and go to school. So, we pretty much walked everywhere or used our bicycle back then. It was typical for families to have one car. Seldom did a family have two cars. Families had one cars. And back then, mothers generally did not work. Most mothers in the 1950s in America were homemakers and mothers. Well, some had outside jobs, maybe part-time outside jobs to help supplement income. Back then, we had a thriving middle class in the United States, which we no longer have. The middle class in America has pretty much been decimated. And so we had the baby boomers, because our fathers went to war, World War II. My dad was in World War II. All of his friends were in World War II. And these fathers came back to a thriving industrial age in the United States, where jobs were aplenty. And there was a growing middle class, and huge communities were being built of basically 2-bedroom homes, small homes. So I was raised in a very, very small home, shared a quite small bedroom with my brother, and my two sisters slept with my mom and dad before they were divorced in their bedroom. And we had one bathroom with one bathtub to share for the whole family. That was not untypical of these war veterans that came home and started raising their families and went back to university and got jobs and founded great corporations. You look at the corporations, many of the stocks that are on the New York Stock Exchange today were companies that were really built and became large industrial concerns coming out of World War II. And so that was kind of post World War II was my childhood, and go to school, and I'd go to school starting at 8 o'clock in the morning, 9 o'clock in the morning. We'd be done at 3 o'clock, and I'd come home and generally change clothes and go play with the neighbors. Whether it was baseball in the summer or ice hockey was my big sport. But of course, that was only during the winter in Minnesota where we had outdoor ice rinks. And so that was kind of, and then as I became a little bit older, again, preteens, an awful lot of my free time was devoted to trying to find a way to raise money, because I knew that the monies that I wanted to be able to buy lunch at school, as opposed to bringing a brown bag with peanut butter sandwich. If I actually wanted to buy a pizza or a hamburger, I had to figure out a way to have that money in my pocket to do so. So, a lot of my time as I became a little bit older was really devoted either to sports or finding some way to earn money, as a junior high schooler or high schooler, to be able to support myself and, and so forth. So, that kind of brought me through my high school years. And then I was fortunate enough that I was a pretty good ice hockey player in high school. And in Minnesota, in the northern states of the United States, North Dakota, Minnesota, Wisconsin, Michigan, New York, Massachusetts, Connecticut, Vermont. Ice hockey is a huge sport for kids, and in many areas of those states, it's the single largest sports for kids. And it was back then, and it still is to this day. It's a sport that draws the attention of young kids in the northern tier of states, but of course now with indoor ice arenas, that's true also in many of the big urban areas in the South. And so I was lucky enough to be a good hockey player, and I earned a scholarship to college. For my first 2 years of college, I went to a school called St. Cloud State College in Minnesota, which is at the upper tier of college sports. It plays the best of the best of the best. College ice hockey teams are played by St. Cloud State University. And so I played college hockey for 2 years, but realized that college was pretty much, and I wasn't a good student. I hated high school. I wasn't. I got out of high school with barely passing grades. I mean, typical grade for me was a C minus or a C. Um, sure, my parents wanted me to do better, but it wasn't really a condition upon which I was going to get allowance, because I didn't get allowance. And so, I didn't take school seriously. And even for the first couple years of college, I didn't take school very seriously. And I kind of felt like I was just, college for me was a placeholder. It was a bookmark. It was just something you did after high school, because I wasn't in the mood to go to work, doing blue collar jobs. I felt like, yeah, there are good jobs out there that will require a high college education. So that brought me to college. But even during college, I lived at home. I did dishes at the university to be able to buy my lunch at school, paid for my own college education. And so after 2 years of being an ice hockey player, I decided I really actually need to get an education. I need to become a student. I need to take school seriously, because I'm running out of track. I've got 2 years done and I can see the end of the track. And I actually what am I doing to actually become accomplished at something where I can market myself? And so I transferred to the University of Minnesota, which was a fine college education. It was a very well regarded school. Again, lived at home for a year, worked numerous jobs during college. I mean, during college, I loaded UPS trucks. I worked and made cardboard boxes in the cardboard box factory. I drove trucks. I drove school buses. I drove a taxi cab. I painted trucks for the highway department. I painted tires for the tractor dealers. I had a wide variety. I worked and cleaned out the cages of an animal research facility where I'd clean out the monkey cages and the rat cages every day. So then, as a junior in college, I actually got married very young. I got my wife and I were very very young when we got married, and so I had a wife to support. Children came very quickly afterwards. So even during college, I had a family to support. So, thankfully my wife pitched in and worked. Her mother took care of our young son. So my wife could work full time, and I patched together pretty much a full-time job while I was going to school, taking a full load of credits. But I did very well. I took school seriously, and for the first time in my life, starting as a junior, I decided I'm going to get all A's, which I was able to do then for the final 3 years of my college, because I didn't get through in 4 years because of the pace in which I needed to be a husband and father and bring in food, bring in money for the family. It took me some extra time. So, that was then 3 years of working and getting my college degree, which I finally got in the field of advertising. And so I got a degree from the University of Minnesota in advertising. And that then kind of launched me into the next phase of my life. So, yeah.
Wow, if there's one word to describe it, I'll say it's a hard worker, man, Peter, hard worker. Do you plan to get married at a young age, right? Was it, something that you always wanted?
Yeah, I mean, I think back then, of course, people did get married. It's we meet a lot of people our age that were married young. I mean, if you were to do research and look at the statistics of the average age of first marriage, let's say, I'm sure our United States government has got plenty of Excel files on that can be downloaded, but that has been steadily increasing. Not only the percentage of people getting married, because in today's America, fewer and fewer people actually, a lot of people live together and don't become married. But back then, at that period of time, which was the late 1960s, people got married a lot younger. They started their families a lot younger. And, the idea of being barely out of your teens, as my wife was before she had her first child, that's pretty much unheard of today. Of course, I was in my early 20s, but we weren't impressed by this idea that, oh my gosh, we're getting married so young. Because there were other people that were married as young as us. We were probably a little bit younger than most of our friends, but not by a whole lot. People generally got married late in college or right out of college. So we weren't totally unusual.
Just one last question, right, before we talk about trading. So, you shared quite a little bit about your childhood, right? So what do you remember as some of the most formative moments, right, during this period that you've just shared?
I was kind of a troublemaker. In high school, I guess you'd call it a juvenile delinquent. I found that I put myself in the way of mischief more often than I probably should have. And some of that had to do with the fact that I didn't have a lot of adult supervision. But I think through that, I think what I discovered is adults are willing to forgive kids if kids are willing to be honest about what they did. If you step forward and take responsibility for your actions, if you're honest and transparent upon what you've been involved in, people are quick, and I think that's probably true throughout the world, not just in the community that I grew up in, but I think it's probably true even to this day. It's a universal truth that people are willing to forgive others when others are transparent and ask for forgiveness and seek to do better. That was something that was impressed upon me. I think the other thing is if I want something, I have to earn it. I have to go get it. It's not going to come to me on a silver platter. It's something that I'm going to have to figure out how to do. And I think a third thing, Rayner, would be you got to figure out how to solve problems because your life is filled with them. You're going to be solving problems for the rest of your life. So you might as well be good at trying to be creative and find different ways to do things until you can find a way to do things that at least will get by, if not actually be successful.
So I totally agree that life is full of problems and it's a skill to be able to solve problems. And now since that you clearly have children who are already pretty much adults. So do you recall any things that you've done for them to help them train to become problem solvers?
I think from an early age for our kids, we told them that they're going to have to get a job. We're going to try to help them the best we can. And then fortunately, by the time my own children became of age, I had succeeded at being a trader. And so, I raised my children in a totally, totally, totally different economic strata with the benefits that are incurred upon that than I was raised by. And so we were able to, help our kids in ways that my parents wouldn't have even conceived of. But nevertheless, we instilled upon them the need to come home from school and tell us things that they probably knew that we wouldn't want to hear, but we're willing to bite our tongue and listen. It was more important for them to be honest than, if they were to do something wrong, the worst thing they could do is then lie about it because they'd be more in trouble. They'd be more trouble for lying than they would be for whatever they did. And that they had to work. It wasn't going to be a free pass. They had to find summer jobs. And if they wanted money during the school year, they might have to work part-time during the school. And so those were things that we really we didn't demand great grades by our kids. I think to some degree, and especially, in your hemisphere, in Asia, parents place a lot of emphasis on great academic achievement. And even in the United States, it's the Asian Americans who are most successful academically. We didn't place that upon our kids. I mean, we're more happy with A's and B's and more happy with B's and C's, but we saw a lot of C's and didn't demand A's and B's. Although we did demand B's if they wanted to drive our car, only because with B's, the cost of our car insurance went down.
Practical, very practical. So let's move on and talk a little bit about trading. So how do you get started in trading after college?
I'm 77 years old. I love trading. I've been trading since my mid-20s. I've traded for a living. I sometimes almost pinch myself and say, really? Really? I was able to figure out a way to support myself and my family by speculating in commodity markets. I mean, how crazy is that? And so after college, I started down a career of advertising. We moved to Chicago. We lived in Minneapolis and we moved in Chicago because I had been recruited by one of the principals of, at the time, third or fourth largest advertising agency in the world with offices all over the world. Huge advertising agency. And I was recruited. We moved to Chicago where I went to work for this advertising agency. And while in Chicago, there was kind of friends we met through our kids' activities. Father, who was a trader in the soybean pit at the Chicago Board of Trade, I got to know him. And John invited me down. He said, come on down to the Board of Trade someday, Peter. We were on the fourth floor of the Board of Trade, all of the exchange pits. and there's a dining room for members overlooking the exchange floor and the fifth floor. Come on down and I'll show you what we do, and I'll show you around the building. And I was just absolutely captivated because back in the days of exchange trading, especially back then when we had just huge volume that had exploded in the early 1970s. United States coming off the gold and silver standard, and inflation, crop failures in Europe and Russia was really the era of modern commodity markets. Was 1971, 1972 into that era. So, these exchanges, and here all of these guys are yelling and screaming and pushing and shoving, and fist fights would erupt, and it was just pandemonium. And I just went, golly, that looks like a cool thing to do. And I was on the fast track in advertising at the time. They liked me. I mean, they knew I was a hard worker, and they knew I was, quote unquote, I was a producer. I didn't wait around for things to get done in my world in advertising, just as I didn't in my world as a person. So I was kind of on the fast, young executive track in advertising. And back then, I think this was 1974. I was making, I don't know, $25,000 a year, something like that.
That's a lot of money.
That was a lot of money back then. And so I decided I'm going to try this commodity trading deal. And so really, I kind of went and I found a large grain company, Continental Grain Company at the time, second largest grain raw material exporter in the world, next to Cargill. Continental Grain, it was a growing business, so they were looking to hire, young guys who wanted to work hard. And so the deal was, okay, we'll train you and we'll actually give you a stipend for a period of time, just enough so that you're not starting with no money at all. This was not MBA fast track world. Back then in the commodity business, everybody started at the bottom. You didn't start with a young executive job. You had to earn it to get it. And so the deal was, if I brought in grain business or brought in raw material business, I'd get a fraction of a cent on a bushel of corn if I could find somebody to do their grain business through Continental Grain. And so they offered me, I think, the equivalent of 1,000 a month, 1,200 a month, something like that, for a period of time, a year, I think it was, to come. And then after that, I was on my own. So I went back to the advertising agency and I said, look, I'm leaving. I'm going to work for half the money. And if I don't make it as a trader, will you hire me back in a year with a 50% raise? And to which they said, yeah, we'd love to have you back. And we hope you fail. Uh, and so it was, down to the word trade, and learn the business, learn symbols that, the letter F meant January, and the letter G meant February, and the letter H meant March, and the letters for July Platinum was PLN, and how many 100 troy ounces of gold were a contract, and you had margin requirements and delivery months, and there were speculators and there were hedgers and there were all of these things, and I had to go find a way to bring business into the shop. I had to go find a way to bring large traders in so I could earn a living. So after the end of a year, I had income. I knew I wanted to be a trader back then, Rayner. I knew that my end goal was to figure out how to trade. I was told by people who I believe that this is a very difficult thing. If your goal is to be a trader, you are in for a very steep learning curve. This is not rags to riches overnight. This is not, I'm going to come in and do 100x every year and grow my account from 1,000 to 1,000,000 in 2 years, and buy a Lambo and, big house in the suburbs with a swimming pool. That this was going to be hard work and it was going to take a while. And people told me that, and I happened to believe them. I was humble enough to think I wasn't going to be this instant success. I was going to have to figure out a way to do it. So, I hustled for business, and I brought in some very large accounts into the business that would do their clearing business through Continental Grain. And I would earn, in effect, fractions on the contract or commission, considered commission against the contract. And I could build up my business while I learned how to trade. And I had to kind of learning how to trade for me was a, three-dimensional puzzle. There's a lot to learn. There's just a lot of things that have to be figured out if you're going to say, okay, I'm going to quit my day job because that's what I wanted to do. I knew I ended up really at the end of a year or two making more from commissions from bringing in customers to the Board of Trade and the New York Merc and so forth than I made in advertising. And so didn't take me long to be earning what I was making in advertising and more by bringing in large customers into the business. But my goal was to learn how to trade. And so, I'd earn enough to open an account, 5,000, 10,000, because the Continental would let us trade our own account. But their stipulation was you're not going to open an account for $100 and trade the dollar yen pair. You're going to have to trade futures, and futures require margin. And so their requirement is you have to open a $10,000 account. So I'd earn $10,000 account and blow out the account. And so I tried trading in different ways. I tried trading fundamentally. I mean, after all, I was working for one of the largest grain commodity broker dealers in the world. There was a lot of good fundamental information that I had access to by very smart people who understood the fundamentals of the businesses I was in. And so I tried to trade it based on economic supply and demand considerations, and that wasn't a success. And then I tried trading spreads where you like buy March corn, sell December corn. So it'd be called an old crop, new crop spread. Or I would try seasonals. I tried trading seasonal tendencies, and I tried trading cycles, and I tried trading point and figure charts, and I tried a number of different techniques. And in the process, there was 1976, 77, 78. I probably blew through 3 or 4 accounts, but I was insistent. And I had a big advantage that a lot of these young kids sitting down their mom's basement on their iPhone trying to trade didn't have. For one, I had an income coming in from commission business, from companies, large chicken growers that were needing to sell 120 million chickens a year and were buying all the corn and meal to raise them. And a gold company, largest gold miner in the United States, I had as a customer. And so I had this income coming in. A lot of these young traders who are trying to trade don't have that. They don't have a steady income. And so I had that to an advantage. I think I had another huge advantage as I was in a building entirely dedicated to the business of commodity trading, where in every floor, in just about every office in that building, there were successful traders who were willing to share information and knowledge with me and do so out of their interest in seeing a young guy who was willing to work hard become a success. And so I heard this chatter all day long from successful traders who were floor traders as well as speculators within the building. And so I think I was lucky enough to learn from people who were willing to share things with me, who were successful. I was in a building filled with successful traders. They weren't pretenders. They weren't wannabes. There were guys that had cut their teeth in trading and has succeeded as trading. And there were several of those guys that were willing to share an awful lot with me. And I think the most successful things, the most important lessons that they were willing to mentor me on is that, Peter, you got to stop losing money in your accounts. You've got to figure out a way to put a tourniquet on so you don't hemorrhage to death. You got to figure out this risk management side of your trading, because if you don't figure out the risk management side of the trading, you're going to be starting new accounts and blowing out accounts the rest of your life until you learn that. It doesn't matter how you trade. Really doesn't matter. It doesn't matter if you're trading spreads or seasonals or fundamentals or point and figure charts or cycles. You can't control the outcome of a trade. It doesn't matter the trade you put on. That what you do with the trade after you put it on is 100 times more important than the trade you put on to begin with. And you've got to manage your risk, and you have to be just aggressive at managing risk. And these were very successful traders that were willing to spend hours with me talking to me about the philosophy of trading, not the techniques. I had no desire to know how they were trading. They had no desire to teach me what they were doing in their trading. They wanted to talk philosophy. And I think that was a big difference back then in the business I came into, is people were willing to share guidelines, philosophies, principles, not techniques. Not, well, you're using the wrong RSI here. You shouldn't be using a 14-day RSI. You need to be switching over. Have you done a computer run on that thing? Are you sure it's an 18-week moving average? Is that a simple moving average or a weighted moving average? That is, all of that stuff is so much BS that it hurts my ears when I hear people talking about it. I mean, it literally is painful for me to hear that kind of nonsense coming from people who are trying to tell other people a thing or two about the whole business of trading. And so these were people that really taught me things like, get out of all your losses on a Friday. Don't take a loser home on a weekend, because it's going to bug you all weekend. It's going to ruin your weekend, and you need to spend your weekend recovering and getting ready to get beat up next week. And so take your bruises on Friday and go home and come in ready to start anew on Monday morning. And so, they taught me principles, I think principles of trading, not techniques of trading. They taught me philosophies of market speculation. And more than that, they taught me that what my worst enemy as a trader is the little inner demons that are part of my character that want to sabotage me at every turn. Because I think in the end, it's one of the biggest factors that are overlooked by people, is that trading is a human endeavor. It's far less an intellectual endeavor. It's a human endeavor that involves really figuring out who you are. I always tell young traders, if you really want to know who you are, the good, the bad, the ugly, become a trader, because you're gonna find it out, and you're gonna look in the mirror and you're gonna see at times personality traits that you really don't like, and until you're willing to be honest with yourself. And this is where human self-transparency becomes so important, Rayner, as you know. Until you're willing to become transparent with yourself as a trader, become real, face realities for what they are. The idea of quitting your day job and becoming a trader just will never happen. Whether a young person wants to seek a career as a trader or seek a way for trading to supplement their day job as an engineer, a doctor, a truck driver, or garbage pickup guy, or whatever the case may be, there's legitimate ways. Not everyone has to be a full-time trader, but until a person is willing to face their inner demons, I think success as a market speculator is always going to be out of their reach.
So what's your trading approach today? I heard you talking about the point and figure chart fundamentals and stuff like that. So today, how are you trading the markets?
Okay, so let me roll back the clock to answer. I'm going to roll back to roll forward.
Okay.
1978, I'd blown out account after account after account, still had the aspiration to trade, had an income coming in, could fund new accounts. And a friend of mine, man that's still a dear friend, said, Peter, come with me. And we went across the street to a bookstore, and he bought me the fifth edition of Technical Analysis of Stock Trends by Edwards and McGee. And I consumed it. I mean, I just a voracious appetite. I just consumed this book. And all of a sudden, it kind of made sense to me. I could relate to it. I don't know why. I could probably wander off and write 100 pages on how that fit my personality in certain ways where other approaches didn't. But it just made sense to me. Here was a way where I could have an opinion in the market. Here was a way where this technique gave me an idea of where I should get in. It gave me an idea of where I should get out if I'm wrong. It gave me an idea of where a market might go. And it was graphic. I'm a real visual person. Even as a kid, I loved books on maps. I could look through, if I'd go into a doctor's office and there was a book sitting on the table filled with maps of the ancient world, I could spend hours looking at maps. I loved maps. And so I was very visual in this idea. All of a sudden, I could figure out a market and maybe trade it based on drawing lines on the chart. This just inherently made sense to me. So I pretty much worked through the Edwards and McGee book more than once. And then I really adopted the fact that I'm going to trade the markets based on classical charts. And of course, Edwards and McGee drove me back to Schabacher because Richard W. Schabacher, Technical Analysis and Stock Market Profits, 1934 it was written, was really the book that Edwards and McGee was based on. And so that drove me back to the original manuscripts of Schabacher, which I just consumed, memorized, and then it was just a matter of working things out. I mean, it's one thing to say I'm going to trade on the charts. It's another thing to actually do it, to figure it out. How do you size trade? How do you time trade? How long are you going to stay in trades? How are you going to set a stop? What are you going to do? And back then, we didn't have computers, Rayner, where you can turn on and you have 20 different charting pieces of software that you can use. This was back in the day where we used graph paper. We bought plain graph paper and we would create the X and Y axis. And we'd wait for the markets to close, and on a quote machine, we'd see the open, high, low, close. So I'd draw the line. And you'd get a bull market where I had to tape graph paper to the top of the chart because we went off the chart. and literally, that's how we created charts. Now, during that time, of course, we had some of the early services come out where we could see simple charts on a computer monitor. But so that started coming in at that point in time. There was also services that you could buy that had printed charts that you would buy and then keep up on your own with a fine Bic pen, and then a month later you'd buy a new set of charts, and so you didn't have to create it based on your own graph paper. So that's really what I did. And, I'd draw in these high-low closes and I'd look at charts and I'd say, well, that looks like such and such. And I'd go back to the Edwards and McGee book, which was very well worn, and look through and compare things. And there were it seems the world you and I live in right now is filled with people who do charts. That was not the world I started in. There were very few chartists. Chartists were few and far between. People didn't use charts to trade. I mean, there was a subset of traders that were chartists, but it was very, very small. And the reality is it's still, while we think that there's a lot of people who use charts to trade today, if you were to take a look at the composition of open interest, what percent of daily volume, what percent of the composition of open interest of these futures contracts are represented by people like you and I that keep up charts? It's a very small number. It's maybe 2, 3, 4% at most. The people who trade markets are not, for the most part, trading markets based on chart patterns that you and I might look at. It was just a matter of working out. And so I started charting markets in 1978, and I started making a little bit, losing a little bit, but holding it together and making a little bit, making a little bit more. And 1979 came around, and I had a really good year. And at the end of the year, I looked. I'm starting to understand this. I'm getting a feel for what I need to do. But then I think the problem was I know what to do, but could I overcome myself, and did I have the patience to wait? Did I have the discipline to pull the trigger? And so I think, for the first year and a half as a chartist, it was kind of figuring out what that looks like. And then it's been my entire life ever since to keep working on discipline and patience and overcoming the human component of trading. And so, 79, I was successful. 80, I was really successful. 1981, I gave up my commission business, quit the grain company, and started factory research and trading as a clearing member of the Chicago Board of Trade. And I have been a trader ever since.
Right. So do you recall what was special about 1979 that kind of like give you your big break?
Currency markets. Well, there were great grain markets. Throughout the 70s, we had these huge bull markets and grains and raw materials that were followed by huge bear markets. It was like a big yo-yo. And soybeans would trade from $4.50 to $10, back down to $4.50, up to $10. So if someone were to go look at quarterly charts, let's say, and look at quarterly charts of corn or soybeans or copper or silver throughout the 70s, what they'll see is that these markets were in big wild ranges. And so we had these big wide range trading that would take place over a year and a half, where you'd have big bull market followed by big bear markets. And so we had those were the markets I came into. They were really, really good markets. They were great commodity markets for traders. And so then in 80, 81, we just had some spectacular moves. We had spectacular moves in the interest rates. We had in 1981, keep in mind, I started Factor in 1981. 1981, Treasury bills in the United States reached a high of 20%. Bond rates were 10, 11%. My wife and I bought a home with 14% mortgage rate in 1983. And so, we had these very volatile markets. We had great bull markets. We had great bear markets. And so we just had some wonderful markets that charted very well. And so I came in, I think it just has so happened that I started the company and came into existence with the company with just fabulous markets to trade. And then, of course, 82, we started this massive bull market in stocks, with Ronald Reagan as the president and economic policies. As prior to 1982, the Dow Jones remained under 1,050 for its entire life. And all from 1968 until 1982, the Dow Jones would go up to 1,000, back down to 500, up to 1,000, back down to 500. Well, 1982 came as we had this huge bull market that came upon us in the S&Ps. Back then, we didn't have the NASDAQ, but we had the S&P contract was around. The Dow Jones contract was not, but we had S&Ps. We had major market index with the New York Stock Composite Index. Those were the futures markets we had that covered stock indexes. We didn't have any of the markets like we have right now. We have wonderful commodity markets in Singapore. I got to tell you, I love the Singapore markets, and I trade them all the time. They're great markets to trade. And I thank you for my hat's off to Singapore. So, but we pretty much had domestic markets, and we didn't even back in the 70s have financial markets. Financial markets really came into being late 70s, early 80s, where we didn't have bonds, we didn't have T-bills. The first interest rate markets was Ginnie Mae mortgages traded at the Chicago Board of Trade. And of course, we had T-bonds came at the Board of Trade, with T-bills, and then Euro dollars that came into being at the Chicago Mercantile Exchange. And so We just had wonderful markets, and those fortunately were the markets that I came into as a trader then when I started the trading company and gave up all my client business.
So the trading company, the factor trading company, is it like a company that just runs the account that you're trading?
It's always been a prop firm. The phrase prop trading that's used today is an incorrect word. It has no clue as to what prop trading really is. I mean, prop trading is trading with your own money. It's not trading customer money. It's not being on trial paper trading and getting ripped off paying a monthly fee to paper trade, thinking that you're going to be assigned all of this money by this quote unquote, we fund you prop firm. Back then, I started factor trading with $88,000. That's the amount of money that uh, when I quit the brokerage business, gave up my brokerage customers and decided, okay, you know, for every trader, you come to the point of taking a leap of faith where I had to say, young guys today that want to quit their day job, there's a point in which they take a leap of faith. They say, my paid job is behind me. I now have to earn it myself. And that was the case for me when I gave up the commission business, opened an account for $88,000 with the decision that I'm going to have to make money to support my family. This is it. If I lose this money, I truly am going back to advertising, or I truly am going back to the commission business and working as a customer's man the rest of my life, because that's back then we didn't have computer trading. Computer trading didn't really come in until it's about 16 years ago. Back then the exchanges weren't open 24 hours a day. The Chicago Board of Trade was open for, I think it was 5 hours a day, then closed, and there was nothing. Commission rates were super high. Back then, as a member, we had cheap rates, but if you were a customer back then, you were paying $50 per contract round turn. Uh, and now people trade for a couple dollars contract for futures trading. Some brokerage firms actually offer it for free. Well, you got to pay the exchange rate and the NFA fee, but there is no brokerage commission. Back then, brokerage commissions were pretty steep. And so, I went in with the idea that I'm going to have to now make money. I'm going to have to turn. And even then, I knew that most of the big trading prop firms, at the Board of Trade really had a minimum of $500,000 to $1 million guys were trading. And as these prop firms would grow, they bring in other traders who they paid salaries to. Back then you paid salaries to get good traders to come in. And then if you found a good trader that worked for another firm, you'd be willing to give them a raise to come and trade for you. And so, I mean, that was the goal, is that, factor trading would not just be me, that we could add traders. But over time, it really pretty much became me. Over time, I've had employees. Now that's not true anymore because I've kind of gone into retirement. Factor as a prop trading firm is still me, but with a lot less money than I was trading back in the prime days, because I'm kind of on the exit ramp to full-time retirement at some point when maybe I won't trade at all. I mean, I don't know if that will happen. It might happen when I lose my cognitive abilities. But and they take my computer away from me, my iPhone and my iPad. They'll confiscate it. They'll say, "Dad, you're losing all your money. Uh, we have to steal your iPad." So, but it was just a matter of that. I had to rent space, and I had to pay rent, and I had to pay for a computer. The CQG started. They were really the first companies that offer small satellite dishes, and that's what I had, is a small satellite dish on my house, and I'd get data, and the data would be fed into a computer, and I had some abilities to do charting on that computer. By about 1983, 1984, we had computers that had some charting capabilities. but I had to pay about $1,000 a month for my data. Data was expensive back then. You had to pay exchanges for their data. But I had to figure out a way, and I was lucky that 81 was a great year, and 82 was better, and 83 was better, and 84 was better, and so forth. So I had early success, and I consider myself fortunate. And I had some spectacular success early in the early years. I've had success since. I haven't had the years like I had in the early years. But then again, I almost start shivering, Rayner, when I think about the risks that I took back then. The risks I took back then were unusual compared to the risks that I would take, now. I mean, I think in the early years, there were some trades where I bet if you consider that 88,000 was my stack, right? That was my stack. And I knew I had to grow that stack because I needed to take some of those chips off the table and convert it to cash to pay my rent and buy food for my family. But I'd have to replenish that stack if I wanted that stack to grow into a real pile of money. Because I felt back then I needed $1 million. If I got to $1 million, then I could really consider myself to be a trader. Until then, I'm still kind of a wannabe. Because generally speaking, prop traders back in the mid 80s were guys that generally had $500,000 to $1 million in their pot. And so, I was lucky in the early years. I would risk 5-10% of my pot on a trade. To me, that's inconceivable. That spooks me today. That frightens me. The idea of risking 10% of my capital on a trade, to me, is a frightening idea. Because I've learned a lot about statistics and the probability of trading. And I know today that if you risk 4% of your capital on a trade, you'll go broke. And it doesn't matter how good a trader you are. The probability theory tells you you're going to go broke. And so I think I was lucky, partially with the markets I was in. Partially I was a hard worker. Partially I was skilled as a chartist. But I think a lot had to do with the fact that I was taught by some really good traders about risk management, and I happened to get into trading markets that were really good. That was kind of the story for me. And then, so I was a prop trader and remained a prop trader. And then in 1986, I was approached by, at the time, what was the largest pure prop firm. Not prop firms like we have today, pure prop firms. They paid their traders to trade. Traders didn't have to pay them to paper trade and be on trial. If you passed through their interview process, if you showed them enough of your track record, they actually did fund you. And so I was approached by Commodity Corp, which had the best of the best traders. When we think of like Goldman Sachs, right? We think, boy, these are the guys that have figured out how to be king of the mountain, and they remain king of the mountain. And there's various firms in each commodity industry which tend to be the big dogs. And so Commodity Corp was the big dog prop firm, and they had guys like Paul Tudor Jones and Michael Marcus and Bruce Kovner and some of the greats of all time traded for Commodity Corp. And they approached me, and I had to provide with the idea, would I be willing to trade their money in addition to my own money? Because I really wasn't interested in trading other people's money. And Commodity Corp approached me, and to earn their money, I had to show them 3 years worth of my statements. And I had to be interviewed by a lot of really, really good traders who would ask me deep questions, not such as, do you use an 18-day RSI or 14-day RSI? These were tough questions that dealt with digging really deep and what are you going to do as a trader? And so then they would assign you money. And if you did a certain performance on that set of money, they would give you more money. But again, unlike these robber scam prop firms today, where you have to pay them to paper trade, back then prop firms would pay me, the standard fee that we would receive from prop firms to trade their money was 5% a year plus 15% of net profits. And so at $1 million, if I managed $1 million for me, they'd pay me $50,000 a year to manage it. Then they would pay me 15% of whatever I earned. And so instead of me paying them like these robber baron prop firms today charge, back in the olden days, pure prop firms actually paid their traders to trade, but traders had to prove themselves first. Rather than to pay to prove themselves paper trading, you had to show that you were a real guy going in. And so that was a real great thrill for me to trade Commodity Corp money for a number of years. And so I traded Commodity Corp money in addition to my own money for, the next 7, 8 years. And then Commodity Corp sold their business to Goldman Sachs. Goldman Sachs moved that business to London and ruined the purity of the prop firm. And so I resigned Commodity Corp.
So fast forward to today, right? You adopt classical charting principles. So let's say you look at a chart today, right? Whatever market. So what are the things that you look for before you place a trade?
I mean, I look for patterns. I'm a futures trader, Rayner. So if there's a futures contract, it's what I look at. And I look at all major futures contracts throughout the world: Singapore, Osaka, Australia, Canada, Paris, London, United States, and so forth. And I've got those all. And my job really begins on a Friday afternoon. It's weird because some people consider Sunday or Monday the start of their week, right? I consider Friday afternoon the start of my week. And the reason is that's the time when I scroll through the weekly chart of every contract of every market that I would conceive of trading. So I scroll through those weekly charts and I kind of go by the premise that if I don't see something in 1 second, it's time to move on. Is that I'm not looking for patterns. I'm looking for patterns that find me. And so I'm looking for classical chart patterns, McGee and Edwards, Schaubacher chart patterns, head and shoulders, rectangles, right angle triangles. Those are the patterns that I really focus on. I despise trend lines. I despise symmetrical triangles. I look for patterns that have horizontal boundaries. And I look for patterns that appear very, very quickly on a weekly chart. So I have to see something on a weekly chart. And I have found that for me, my preferred pattern, my sweet spot, so to speak, my sweet spot is a pattern that's between 8 weeks and 16 weeks long, that appear as a classical chart pattern, a rectangle, right angle, a triangle, or a head and shoulders on a weekly chart. So I'll scroll through hundreds of charts because it won't be just one soybean chart I'll look at. I'll look at different continuation charts, different contracts. And so I'll scroll through. I think my scroll list right now is somewhere in the area of 300 or so charts. And that'll take me about an hour. And so I'm checking the charts that pop out at me. Now, obviously, among those charts will be markets that I have a position that I'm carrying home on a Friday. On Friday, I don't flatten up each day. I'm a position trader. I carry positions over a weekend. And so there are positions that I have on a Friday. So obviously I'm interested in those markets, but I'm not interested in any other markets that pop out at me as a really good pattern that I recognize immediately. So I check market, and I end up, after going through all these charts, I'll end up with a list of maybe 15 markets, 15 contracts, 10 to 15 contracts, for which I may have a position in 5. And so then it's a matter for me to go back through those charts and now look at daily charts. Again, I'm looking at daily charts, not to study. I mean, people used to say to me, I used to hear traders say, And I'd say, what are you going to do tonight? Well, I'm going to go home and study my charts. Well, what a crazy ass idea that is. Who studies their charts? I have no desire to study a chart. If I have to spend time enough to study a chart to find a pattern, there isn't one. And so I want a chart. I want to find a pattern that grabs me by the throat and says, look at me, I'm here. And that's the pattern I want, is it's self-apparent, ready, no contradiction, no doubt about it. If I have to wonder, well, I wonder if I draw the line here, or I draw the line here. No. And so I end up with this, and then I have that list, and then I forget about the markets on Saturday, forget about the markets on Sunday morning because I have church. So then about 2 in the afternoon on Sunday, my time, Asia starts thinking about opening. And so, I start then going back through this list of 15 markets and asking myself the question, where do I want orders? What markets am I going to place orders in? And so I know I'm going to place orders in the markets for which I have a position on, because that market, I automatically have 2 orders that I'm going to have in. And I put them in as GTC orders, good for the week. And I'll have a stop order to protect my trade, and I'll have a target order to get out if it reaches my target. And so those are the 2 orders that I have going in on any trade in which I have a position. But then I look at the other markets and I say, okay, what markets am I considering a new position in? And there's usually 3 or 4 markets. So those are the markets that I already know. I already know on a Sunday afternoon what markets I'm likely to trade during the week. And there very seldom will I add to that list during the week. I might add a market or two when the week starts progressing. Someone may bring something to my attention. That all of a sudden I'm looking at a market that I had not considered on a Sunday, but that's rare. Usually on a Sunday, I pretty much know what orders I'm going to have in during the week, what markets I might consider a new position in during that week. And that's pretty much just based on I do some candlestick charting. I'm not a candlestick guy. You are, and you're a good one. I talk to some traders that I have respect for that are candlestick people. I don't care what their positions are, and I don't care why their positions are. But I might just ask them, does that candle, what does that candle tell you? That might then come into the equation, because then I don't day trade. I don't like entering orders during the day. I like having orders in at the start of trading. By the time that Tokyo opens and I got markets that open, and the Osaka futures and the Nikkei futures, and Singapore rolls around and we get Singapore opening up, I want those orders in as good till canceled orders, and I don't want to change those orders on Monday. And what'll happen then is I get alerted. If any orders that I have in get filled, I get alerted. I get blasted on my iPhone. I get blasted on my iPad, and my computer starts making very loud noises that I can't ignore. And then I know an order is filled. And so I want to know which. And then I let things trade. And about 4 in the afternoon Mountain Time, which is 6 in the evening New York time, things start opening up in the U.S. We have currencies that start opening around the world. About 3, 4 in the afternoon my time, I can start seeing the early currency pairs open up. Corn opens up for me at 7 o'clock. Grains open up. So I'm aware of markets opening, but I'm not interested in what markets are doing, because I'm interested as a trader. I am a glorified order enterer. People glamorize the business of trading. Trading should not be glamorized. I have been in the offices of some of the most successful traders in the world. And when you go into the offices, you think you're in an undertaker's. It's like an insurance company. It's all business and it's quiet. No one's yelling. No one's screaming. People are just diligently doing their work quietly. And that's the way that I try to run my trading business. I get my orders in, and Every afternoon, I'll go through the daily charts of my list of 10 or 15 markets. I'll go through the daily charts and ask myself, is there any reason for me to change the order that I will have in tomorrow? And if there is a reason for me to change the order that is intended for tomorrow, I will then make the change at that point, late in the afternoon, early in the evening. I'll make the change to get ready for the next day. So today's Tuesday, tomorrow's Wednesday. All my orders will be in by the time I go to bed tonight. I won't change any of those orders tomorrow. I'm not looking to day trade. I'm just looking to place orders that make sense based on charts as I read the chart. That for me, Rayner, is the critical question I have to ask myself is based on how I read charts, the orders that I have in, whether they be orders to take profits, protect a trade, or enter a new trade, does that order make sense? Is that chart compatible with the order? That is always the major question that I ask myself about every order that I put in. Am I going to be able to look at this chart a year from now and blow this chart up and paste it on a wall and go and stick pins into that chart wherever I bought and sold it, and step back 10 feet, look at that chart and say, did the orders I put in that chart make sense? Whether they were profitable or not does not make any difference, because I'm wrong on 45, 50% of my trades. I am okay being wrong on 50% of my trades. It just doesn't bother me one bit. But more important to me is not whether a trade is profitable or not, but did the trade make sense? Was it a smart trade, not a winning trade? Was it a smart trade? And I think that's something, Rayner, that knowing you can relate to.
Yep, totally. And also, just to backtrack a little bit, earlier you mentioned that on Friday you looked through about 300 charts on the weekly time frame between 8 to 16 weeks, if I recall correctly. Then you like to go down to the daily time frame to place your orders. Right? So I would like to know what are you looking for specifically on the daily time frame before you decide whether to place that order or not.
Okay, so I know I have to have a great example here recently was the Nikkei index. Traded both in Singapore in Osaka. I traded it in Osaka. I could have traded it in Singapore. I happened to trade it in Osaka. But we had a pattern there. We had a massive multi-month cup and handle pattern, which and then at the tail end of that, at the handle itself was an ascending triangle. You can look at a chart and see that.
The Nikkei, right? Okay.
Yeah.
You call it the Nikkei. Yeah, it's traded on 4 different exchanges, if I'm not wrong. Okay.
Yeah.
Yep. Sometime, I'm guessing, in January this
Yep.
year.
Yep.
Okay.
Yep.
January
So,
2024. Yep.
Yep. So I'll see that chart and I'll say, I like that chart. That is a chart we're placing a buy stop above the market because I enter on breakouts. I'm a breakout trader. I wait for breakouts. Now, I know there are some people I know try to get in early, and I think that there are different daily bar patterns and especially candle patterns that do allow a trader to try to take a run at a pattern before it completes. I once did that. I no longer do that, not because I don't like that approach. It's a matter I don't want to trade as much as I used to. I used to enter 30 to 40 new trades every month. As I get a little older, I don't want to have to work that much to manage my order book. And so I really am trying to keep myself down to maybe 2 trades a week, and really kind of want to work in the direction of only average of 1 trade a week. I don't need a trade. It might be a week when I do 3 trades. Might be a week when I do no trades. Last week it was a week that I did no trades. This week I think I've already entered 3 new trades. And so if I see a pattern I really like, then I enter on a breakout. I use ATR, average true range. I use a 30-day average true range. Again, I'm not going to get into an argument with anybody. Well, Peter, why don't you use 20 ATR or 40? I have more success with 40 ATR. To which I go, I hold my nose at that one. That one stinks. I don't care what it is. It could be a 10-day ATR. I'm not going to get in that argument. But whatever it is, use it and use that alone. Be consistent, be smart. And so I use a 30-day ATR, and I have a grid to say if the pattern is an 11-week pattern, I look at a pattern, I say, what's the really critical level where we break out? I want to know in the case of the Nikkei. I don't have the chart in front of me. I'm not in the computer room. But if it's the Nikkei, I had a price that said, this is my breakout point. And if it's an 11-week pattern, I look at this grid and I say an 11-week pattern, I'm going to use X% of that ATR as the place to which I'm going to place my buy stops. The longer the pattern, the more I work toward 100% of the ATR. And if it's a 3 or 4, if it's a 6-week pattern, I might only be using 20% of the ATR to determine my buy stop place. And I figure out my buy stop. I put my buy stop in. And when I put my buy stop in, I don't wait to be filled to already be thinking about my risk management, because my risk management has got to be thought through in advance. Before I go into a trade, I want to know, where am I going to say I'm wrong in the trade? So I want to know, in addition to what trade I'm going to do, where I'm going to enter the trade, I want to know in advance, where am I going to get out of this trade once I get in if I'm wrong? Where am I going to take my loss? And so I have various little techniques I use to determine where is once I'm filled on a buy stop and an Nikkei, I don't want to wait for that to happen in order to put in a sell stop to protect my trade. I determine that in advance, and then I attach a sell stop to my buy stop. As you know, Rayner, it's what known as a contingency order or a what if order. Different exchanges call it by different names. Different brokers call it by different names. But it's a what if or a contingent order that says, if my buy stop in the March Nikkei on Osaka is filled, the minute it's filled, I have an order that slips in behind it to protect that position. And once I know that position is filled, I also then will enter, usually on the same day, an open order to take profits at the indicated profit. So I just always want to make sure that I'm covered with orders that are covered. And so, at any given time, then typically I'm in a losing trade. I get out quick. I do not mess around. Once I'm in a trade, my driving ambition in a trade is to try to find a way to have break-even stops within a week. I want to, within a week, be managing that trade so that if it goes back against me, I get out at break even, in some cases, even a small profit. I don't want to get into a trade, have a profit, and then have it dig into my pocket. And so my driving ambition is to try to find a way to move my stops quickly. Now, I don't trail stops much past where I got in, because I want to give markets a little bit of room to move. I want to give a market a little bit of room to back and fill, but as a general rule, if I have a losing trade, I'm out within a few days, because I automatically cover losing trades on a Friday. So if I have a loss on a Friday, I look at my book. I'm not always in my office, but I am in my office late in the session on Friday, because I want to get out of losing trades on Friday. So I want to know any trades that I have on that are losers on Friday, because I want to enter an order before the market closes to exit the trade, because I don't want a loser going home. And so then so generally I'm out of losing trades anywhere from a few days to a week. And as a general rule, I'm in winning trades anywhere from a week to a couple months.
Okay, so you shared a lot. So let's kind of like unpack these different components one by one. So you talk about setting the buy stop order, for example, Nikkei, right? You say that if the pattern is shorter in duration, the percentage ATR percentage is smaller, and if the pattern is longer, the percentage ATR is larger. I'm guessing that you use that as a buffer on top of the high and add that amount, right, to
Yeah,
your buy
I
stop
add
order.
it to the high.
Why a larger pattern requires a larger percentage ATR and why a smaller pattern requires a smaller percentage ATR?
Well, and it's just not smaller or larger. It's not. I'm not measuring this in duration. I'm also measuring this based on the width of the pattern because I have found that for me, the patterns that generally have the best outcome are patterns that from high to low are no more than 15% of the value of the underlying contract. So if we're talking about $10 corn, right, or $10 soybeans, and we have a big pattern that develops in soybeans, I would not want that pattern in soybeans to range any more than $1, let's say, 10% of the price. And so I'm looking for patterns that tend to be tightly compressed. And so that you have a lot of buying and selling in a very narrow range. Because I have found that the tighter the compression, the more explosive is the exit. And so that on a shorter pattern that's tighter, I can have an entry stop that's closer to the price, knowing that as a general rule, once it breaks out, it's going to break out with more vigorously than a big, broad, lazy, what I call them long and lazy, a long and lazy pattern where, it's a 6 month pattern and it's a 20% price range from high to low. And and it plays out over a long period of time. A small breakout doesn't really mean that much in that market condition. It's really not that important. If you have, Bitcoin at $45,000, what does $100 mean? It means squat. It doesn't mean anything. It's a meaningless number. And so I try to gauge that and I measure that. And that's something I do when I'm entering entry orders is I make that determination. And I'm sure that you young guys would have computer programs to do this all the easy way for you. I'm kind of old school, Rayner. I'm very much old school. I kind of have a sheet of paper and a calculator and work it out by hand.
You're not alone, right? I have my own calculator here as well on the
Yeah.
side.
Is that a Casio?
Oh yeah, it is. It is a Casio. You can see over
Yes.
there.
Hey, I love Casio traders.
It's been I think over a decade. It's still alive and kicking.
Yeah, well, I have an old one. So, yeah, I still use a little old handheld Casio is how I figured out these ranges. I write it down on a piece of paper and I've kind of graduated in the last 5 or 6 years to an Excel spreadsheet that I leave open and never save, but have calculations that I look at a few days later and have no idea what they were.
So next one, right? So earlier we talked about the entries. Now what about stops? I think it's something you've not covered yet. You mentioned you have a stops to know when you're wrong. So how do you kind of like decide at which point I should be out of the trade?
Let me cover something even before that I think is even more important, Rayner, and I think you'll agree when I start talking about it. Sizing. Sizing is where is really the thing that end up flunking people out more than anything else is sizing because they oversize. They're too big. They get too big. They get too big quickly. They get winning trades on and want a pyramid. They get too big. I just think that sizing is one of the least written about, the least understood, the least appreciated, the component of trading that there is what's your sizing going to be? And for me, I calculate that sizing based on, okay, I know on the Kai that this is resistance. I know I get in here and I know that I get out back down here, that if it goes back through and works its way back into the pattern, a certain amount, I blow out. So I know the distance. I know I'm in the Kai here, I'm out in the Kai here. And I calculate what's that worth per contract? How much we talking about per contract? And because when I enter a trade on let's say $1 million account, $1 million bucket of money, I don't want to lose any more than $6,000. $6,000 to $8,000 is about the maximum that I want to lose out of that $1 million by going in Nikkei. Now, Nikkei, I went heavier. I went up to 100 and I went to up to 1.1% in my Nikkei trade because I really, there was a lot of things going on with it that I really liked. And so I went up over 1% of my capital, 100, and I expressed that in basis points. A half of 1% is 50 basis points. 1% of capital is 100 basis points. And so I don't want to really risk any more than 0.6 to 0.8 of 1% of that $1 million on a trade. And so I know I'm in here. I know that initially I'll get out here if it's a loser. So then I calculate my sizing based on that. Is that if I know that this is what it is, and I know that I'm going to risk, let's say, $10,000 on the trade, how many contracts can I go into? That determines my size. And so then after that, it's a matter of how do I bleed the risk out? That's my initial risk. My goal then is to bleed off that risk. I want to get rid of that risk and pass it on to somebody else. And so it's a matter of trying to figure out, and usually when I enter a trade, I divide it in half. I've got this many contracts as part of the trade, this many contracts as part of the trade. I'm more aggressive on a half. I'm a little more willing to give the market a little more room on this half. And so on at least half, I want to go to break even, maybe by the end of the first day even, or for sure within a day or two. And I want to start moving the stop up on the other half within a day or two. And so my motivation then is to try to bring that trade down so that within 4 or 5 days in that trade, maybe the worst that's going to happen to me is I'll break even or maybe lose 0.2% of my capital, $2,000, let's say, per million. So that's my motivation. So I'm looking to do that. Again, that is, I make those changes 4 o'clock in the afternoon each day.
So you decide how much to risk on each trade, 60 basis points on average. So before you decide how many contracts to buy. So the other side of the equation is that you have to know where is your stop level before you can decide how many contracts to buy. The stop is kind of like nearer, then you can have more contracts, right? If it's further, then less contracts. So how do you then assess, which level to base your number of contracts to buy on which level?
Wonderful question. I get asked that a lot. A lot of guys use ATR trailing stops. I don't like ATR trailing stops. Never have, never will. I like stops to be based not numerically, but visually based on bars. And so I always know. So keep in mind that before I get into a trade, it's still in the pattern, right? It hasn't broken out of the pattern. The day before I'm in the trade, it hasn't broken out of the pattern. And so I always know what the last day bar within that pattern is. I know it, I can go in my charts and I can find out any market that's still in a pattern that I'm looking at. I know what the bar is, that last bar, assuming it's going to break out tomorrow. And so I try to, let's say in the case of the Nikkei, I had my initial stop just below the low of the last full bar in the pattern. So I can look at that chart. It hadn't broken out yet in early January. And day by day, I can know what's the last bar that's on that chart. And so my protective stop is below the low of the last full bar in the pattern. Now that can create havoc and has this week already because we had huge last day bars in the currencies. If you look at the currency charts, British pound, Australian dollar, you look at the charts we had in currencies, we had huge last day bars, which were last Friday's bars. We had huge last full bars in the pattern. That creates a problem for me because my risk is much larger per contract than I want, which means my sizing gets cut down to the point where I go, God, I'm taking a lot of risks. Really, my whole risk reward matrix gets all blown out of whack. It becomes really lousy. And I don't like that. And so I'd rather have a market rather than, be way up within a pattern. Like if you look at the chart of the British pound, it was way up and slammed down through the lower boundary of a chart pattern with a huge range the day before the breakout occurred. And I don't like those. And so those create some difficulty for me, where I then will say, rather than to use the high of the last bar within the pattern, I may try to look at a 4-hour chart and see if I can't trim that risk out a little bit. I don't go any lower than a 3-hour bar to make that determination. I don't want to go into hourly charts or 10-minute charts or minute charts. I view that as kind of kissing your cousin. I don't want to kiss my cousin. I want to have a real affair with a trade, not a kissing cousin affair. And so, I'll try to find a meaningful spot that says, I'm going to make this market get back into this pattern, at least initially. I'm going to have to make this market prove me wrong by trading a substantial amount back into the pattern for me to say, maybe my analysis was wrong. Maybe my timing was wrong, but that doesn't matter, because you can have bad trading, or you could have bad timing, or you could have bad direction. But any one of those means a bad trade. So it doesn't matter if your direction is wrong or your timing is wrong. You're wrong on either run. It's a trade you don't want to be in very long.
So let's talk about the shifting stops to break even. You mentioned that you have like two different trenches, you want to call it. The first one is more aggressive, second one is more conservative, right? So how do you then decide, let's shift the stops to break even, right? Maybe for both trenches, what's the thought process?
Okay, so what'll happen, I don't know how deeply I want to go into this next subject other than just to mention it in passing, do a drive-by shooting, so to speak. I have just found every year, year after 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 year, somewhere between 10 and 15% of my trades produce pretty much all of my net profits, right? So last year I had, let's say, 150 tranches or 75 trades, let's say. Let's just use a round number. Let's say this year I do 100 trades. And this year I make $500,000 trading. I can know out of those 100 trades that 15 of those trades will basically account for at least 80% of the net profit. And so I call those Pareto trades. They're the trades that delivered my bottom line. Year in and year out, for me. 15% of my trades produced 85, 90% of my profit. Now, the significance of that, Rayner, is that those 15% of their trades have acted very differently than all of my other trades. When they break out, they generally go. The trades that coincidentally put in my bottom line are trades that don't mess around. They break out and they go. They don't horse around. They don't put me through emotional cruelty to determine whether I'm right or not. Because I have a profit at the end of day one, and I never really have a losing loss after day one. And so I know that what I'll try to do is, once a market breaks out, no longer do I use the low of the last full day in the pattern, as in the case of the Nikkei. I'll know what the low was of the breakout day itself. I've just been filled. And so I get an order back that tells me I bought Nikkei, I bought March Nikkei, and I can look at a chart and I can say that was the low of the day at which I bought the March Nikkei, and I can immediately move my stop to below the low of the last day in which we exited the pattern. So that's my first chance to move stops. Then if the next day, let's say the market comes back down and it kisses the boundary line, but then firms back up. Maybe it even closes a little bit lower, but it goes down and it kisses that boundary line. Maybe it really even re-enters the pattern just a tiny little bit, but then starts to recover. Then what I have is a case of a retest low, and I can move my stop to the retest low. And so those are the first two levels that I can move my stop from below the low of the last full day to below the low of the breakout day to below the low of the retest. So automatically I'm starting to move my stops in the direction of a trend.
So just to do a quick recap in case the listeners are confused, right? So the first stop level, if I'm hearing correctly, is before the breakout, the candle prior to the breakout. That's the first level. The second one is you shift up higher when the breakout occur on that candle, that low of the candle be your second one. And then if you break out and does a retest, like previous resistance becomes support and it bounces up higher, that new low will be another reference point where you can shift that stops up higher.
Yep. And it's at that point I moved from high-low bar charts to candle charts. Because what I may know that you have a little retest low on a bar chart, but when I look at a candle chart, you have some spindles and you'll have a real body. Is I may be able to sneak that stop up to below the low of the body of the retest day. And so I've jammed it even a little bit more. And so I'm always looking to jam a stop.
So when you shift your stops, are you, let's say if the market touches the level, does it mean that you're immediately out or you're waiting for a close below the level, for example?
Immediately.
Immediately.
Because who knows? I mean, you may have a market that cascades. You may have some news that comes out in the market. You may have a grain report, USDA crops in all position. You may have action by the Fed. You may have bank intervention. You may have some politician say something stupid, which in the United States happens not every day, but every minute. And so, you have all of these things, Rayner, and the reality is I don't want to come in and look at a market that all of a sudden, rather than risking 30 basis points, I've just lost 100 basis points. I'm okay getting stopped out intraday. Getting stopped out of trades is not something that bothers me. I think fear of being wrong in a trade is a crippling condition for a trader. It's just, if you've got people out there, and I meet a trader who wants to be a trader, and I ask him just the question, how does it affect you when you get stopped out of a trade? If I get a certain answer, I'll say, I think you probably ought to just quit trading. It just may not be for you. It may not be for you. The reality is that trading is not for everybody's emotional makeup. Now, someone can do better that way. Someone can learn skills that can compensate for certain things. But I think the sharp reality is that only a certain percentage of people who start down the road of becoming a trader succeed. And a lot of those succeed not because they used an 18-day moving average rather than a 10-day moving average. They succeeded because somehow they had the mental and emotional constitution to persevere.
Beautiful is it, yeah. It's like, for example, just a sidetrack. My mom, she's someone who can't stand losing money, like 50 cents, a dollar on the floor. She drops some money, she'll freak out and panic. People who nickel dime every single cent, right? Tracking where they lose their money, how they spend it. I find it's very hard to be a trader because you gotta let it go. The losses, you just gotta let it go and trust that follow the process. Eventually, the money will flow. So such people like my mom, she's not gonna make it as a trader. Nothing wrong with that.
No, nor my wife. My wife would never make it as a trader. And, I knew early on my boys would not make it as a trader. So I didn't really encourage my sons to be traders because I really felt they have giftings. They had other giftings that could have done them better in life. And, then from there on, I tend to be slower to move stops after that point, Rayner. Once I really have a trade locked in where I know I'm pretty much break even, it's from that point I'm not real quick. I have no desire to look every day and to move a stop in the direction of a trend every day. I want to, at that point, to start being a little patient with the positions I have on.
So earlier you mentioned that there were two trenches. So was it the first trench where you're more aggressive in shifting the stops?
Yeah.
Okay. And let's say if this first trench, the stops is hit, what about this second trench? How do you then manage the stops on this second trench?
I often will just want to be long a market if the and I do use moving averages, but I don't use moving averages systematically. If I were to start today, I, like you, would probably go in the direction of systematic trading. It just wasn't a career path when I started trading. It is now, and I'm glad it is. And I would tell anybody that wanted to be a trader, learn to code. If you don't know how to code, you shouldn't be a trader. You need to learn how to code. And I don't know how to code, but I'd say don't even think about being a trader if you don't know how to code. The key thing on that, you use some moving averages. I use an 8-day moving average. Now, I could use a 6, I could use a 10. Some of your listeners will say, Peter, why don't you use a 10? Why do you use an 8? Well, I use an 8 and I use an 18. But I don't use them where some people use trend lines. I kind of use these moving averages as a proxy for trend, right? Just nothing but a proxy for trend. And I know that if I'm long a market, those moving averages better be pointing up and price better be above them. And the minute either of those moving averages go down, and I'm not going to go into complication on the interaction between those two moving averages and price, because I think it's frankly irrelevant, because they're mine and everybody else has to figure out what's theirs and how they use that stuff. And so I just know that as long I'm in that trade, and if either one of those moving averages were to flip in a certain way in relationship to price, I want to come out of a tranche. And so the tranche that I am slower to move in is very key to an 8-day moving average.
So now we've covered entry, stops. So let's talk about targets then. How do you then decide, where do we take profits?
Measured moves. Inherent in a chart pattern is what Edwards and McGee called the measured move. And that is that if you have a pattern like the Nikkei, you should look at the Nikkei index and see this huge cup and handle pattern. There's a way to determine, coming out of a cup and handle pattern, the magnitude of the possible magnitude. I'm using the word possible, not probable, because I don't believe in probability applied to patterns, but the possibility of a market going a certain direction. I know that that's there, and so I'll determine targets. And in the case of the Nikkei, there was a measured move target that was developed by the handle portion, which was an ascending triangle, as well as by the cup and handle portion, which was the larger weekly trend. So I have two targets, and so my intent is to come out of half my trade at each target. And so I have open orders to come out of half my trade at each target. And so I determine those targets based on the principles of measured moves as laid out by Edwards and McGee and Schabacher, go into the process of determining the targets that are generated from certain patterns.
Okay, and what if, let's say, the price is reaching 80% to the pattern, right? But somehow it starts to show signs of reversal. So what? Do you let it hit break even or kind of like give it room to breathe?
No. Once it gets to 70%, I say, I'm not going to let you take all this money. That I've got enough money in my pocket that I'm not going to let your hand go in there. There are certain things that I take place for me when a market gets to be a certain percentage of what I think will be the move, where I become, at least on one of the tranches, very, very aggressive in protecting that trade, as I will move stocks up extremely close to the market. Like in the case of the Nikkei, we are down testing some recent lows in here from the last couple of weeks. We blow through the recent lows in the last couple of weeks, and then Nikkei, I blow out of a tranche or half my position.
And you also talk about, you like to close any losing trades on a Friday. So is that kind of like based on some stats that you might have, or is it just to help your psychology overall?
Well, yeah, I think there's two things that go into that. Rayner, there's two things. Is I I don't like negative energy, and part of my deal in trading is how do I shed negative energy? How do I get rid of negative energy? Whether it be through the practice of a religious faith, whether it be through exercise, whether it be through relationships with others, whatever, meditation, whatever the case may be, how do I get rid of negative energy? And so part of it is you carry a trade home on a weekend, you tend to think about that loss. If it's a losing trade, it's kind of, oh my goodness, I have a loss. What's Monday going to bring? Oh my goodness, what you're alert to news, you're long gold for the weekend. What's going to happen? What's happening in the Middle East? Oh my goodness. I don't want to have to think about a losing trade on the weekend. I want to get rid of that negative energy. But there's another thing, and that is I just know from 49 years of trading, the trades that are at a loss on a Friday generally get bigger the next week. And so the probability of a trade that's a loser on a Friday stopping me out with a bigger loser the next week is really quite large.
All right, got it. And I like to talk about the markets that you're trading. You've been trading since the 1970s. So compared to the markets that you're trading today, do you see any differences back then? Between the 70s, 80s, and now?
Yeah, charts don't work as well. I mean, charts in the 70s and 80s were magic. I mean, they really were. I mean, you'd see a pattern. Patterns didn't fail very often. They fail all the time now. There's false breakouts, premature breakouts, morphine of charts. I mean, that's standard now. So, I have to trade more patterns to find the ones that work. That's one thing. I think the markets are more volatile now. The volatility is greater. I mean, it's greater in absolute terms, right? Because we're not trading 60-cent copper now. We're trading $3.50 copper. And so the daily range just in value per contract of copper is bigger now just because the average price volatility is bigger. But even beyond that, if you take the percentage of average daily range relative to price, yeah, from back then, it was less than it is now. And so not only do we have the greater absolute volatility because of prices being higher, but we have greater relative volatility because I think due to greater global participation as well as high frequency and algo traders. I think high frequency and algo traders are the traders that tend to produce the spindles where we didn't spindle as much. I mean, we didn't use candle charts back then, but if we were to have used candle charts back then, we would have larger real bodies relative to full ranges than we have today. All these spindles today, I don't pay much attention to spindles. I tend to draw my lines right through spindles with no regard whatsoever.
So now I'm going to kind of cover a few tweets that you have mentioned previously, and maybe just let you expand a little bit more on it because I thought some of those tweets that you have written, right, were quite interesting. Yeah. So let's see this one. Okay, this quote, right, reads, right, I believe it is important for a daily chart pattern to launch the completion of a weekly or monthly chart pattern. Can you expand more on that?
Yeah, so if you took you have a weekly pattern in the Nikkei, and you go then to a daily pattern, and in most cases you'll see some components that look alike, right? That if you have an ascending triangle on the weekly chart, the chances are then when you go out to the daily chart, you're going to see something somewhat similar. And so I have to determine ATR. I have to determine average true range. And so I'm interested then in the daily pattern because after all, I can't trade a weekly continuation chart. I have to trade a real contract. And so in the case of the Nikkei, in the case of currencies right now, I'm trading the March contract. So I want to know where those breakout points on the individual contracts are because that's the contract that I'm trading. And so that's the contract in which I'm entering. So I would rather, and I think I don't know whether maybe I tweeted that incorrectly. because if so, I'm going to correct myself. I like to see the weekly chart break out before the daily chart, because that tends to tell me that the strength is coming from the nearby contract as opposed to a deferred contract. That, if I'm trading on the long side of crude oil, let's say, I want the March contract to be stronger than the April contract, to be stronger than the May contract, to be stronger than the June contract. I want to see the nearby contracts lead the back contract, whether it's going up or going down. I want to see the greater weakness or strength in the nearby contracts, which means the continuation chart will, in those cases, break out before the daily chart.
Okay. And speaking of trend, right? I wanted to ask you this earlier. So I understand you focus a lot on the classical chart patterns, but do you take into account, let's say, the trend of the chart that you're trading on the time frame? Let's say you have a head and shoulders pattern that's forming, but it's in an uptrend. So do you give weightage to the uptrend against the head and shoulders pattern?
No, I want to trade. I want to trade each chart for what it presents to me. So I don't want a bigger narrative than the pattern I'm dealing, which also will comprise where the moving averages are. So I want moving averages then to be the determination of trend for me, rather than something that took place months before. And
Got it.
so I want to be as real time as possible into the duration of the pattern itself. And rather than dig back and create some narrative that goes back 3 years.
Okay. From what I see on Twitter, you also, tweet about Bitcoin. So what is your take on crypto? Curious to hear.
I actually think Bitcoin has a store of value. If I look at where my money is, look at the amount of money I have, let's say, in Berkshire Hathaway, or the amount of money I have in QQQ, I'm talking retirement money, not trading money. Real assets, what I consider real assets. I have more real assets in Bitcoin than I do in any stock. I am kind of a Bitcoin believer. I wouldn't call myself a full maximalist by any means. But I have a fair chunk in Bitcoin, and I think probably because I got in early enough and maybe and I've done a pretty good job sidestepping some of the big corrections. Not a perfect job by any means. And so I happen to think that the surest trade of all time, the most sure trade that I could ever tell anybody is that the fiat currency that runs their country will be worth less in 10 years than it will be today. That I know that the US dollar, when I was born, a dollar bought a dollar's worth of goods. That same dollar today buys 5 cents worth of goods. And you can go around the world to the Singapore dollar, you can go into any fiat currency in the world, and the surest bet is that that will decline in value because of printing press and the actions of Federal Reserve Bank. And so it may change, but I think right now Bitcoin is a real good case to say it is a great store of value against the destruction of fiat currencies. Therefore, I want a portion of my assets in Bitcoin, if for no other reason than to be an insurance policy against the whole rest of the portfolio.
Great, thank you for sharing. So I'm guessing that would be like kind of like HODL, right? Just kind of like hold it till forever or till you change your mind.
I only have half of what I had in 2021. And I will trade in and out of half of that half, but half of the half, which frankly represents, I'll say somewhere between 2 and 3% of my net worth. Now, if I'm a younger person, I'd want it to be a lot more than that, but I'm not a younger person. And if I should pass away, my family wouldn't know what to do with the Bitcoin. So I have to be conscious of that, right? So I'm happy with that. So I just think that people of my age do not want half their money in Bitcoin, but the younger people are, the greater percentage, I think, should be a consideration for something that they consider to be a store of value, whether it's Bitcoin whether it's high grade corporate bonds, whether it's blue chip stocks, whether it's companies will exist 20 years from now. I think we all know McDonald's will be around 20 years from now. So I want to own some McDonald's stock because I think it's a store of value, right? I think Apple is a store of value. I think Bitcoin is a store of value. And so I just think that for me, I look at Bitcoin as a store of value.
Okay. And another tweet, right? I think this is just one last tweet over here. Let's see. Oh, this is actually about stocks. We haven't talked much about stocks, so I'm curious. Do you trade individual stocks or?
No, I don't. I do in retirement money, but that is money that's entirely separate from my business account. My business account is the factor prop account. That's my trading account. That's what I do day in and day out. But under the law here, we're able to bypass some taxation by putting monies into longer term equity buy and hold positions. And so there I will look at, I own Berkshire Hathaway, I own Apple Computer, I own McDonald's, I own Procter and Gamble, I own companies like that sit in an account that I don't actively trade.
So I'm just going to read this tweet and just kind of like hear what's your take on there, right? So it says, whenever the general market gets whacked, be alert for stocks that quickly move into important new high ground. So I'd like to hear your thoughts on that statement.
If I was a stock trader, I would have lived and died by this tweet. Okay. This tweet would have been my bread and butter, but I'm a commodity trader, so it's a little different. But I've noticed that whenever you have a big correction in the stock market, like 10, 15%, broad indexes, right? They get clipped by 15%. That if I was a stock trader, one of the things I would look for every day then would be stocks that made a new 52-week high. Because there are going to be some stocks that weathered that storm that didn't have that big correction. They didn't have a 15% correction. They had a 3% correction, a 5% correction. And then that the minute the bottom is formed for the bigger correction, these stocks are already poised to make a new high. And those would be the stocks I'd want to own.
I believe this is the concept of what they call relative strength, right?
Relative strength, yep.
So do you use this concept in your own futures or currency trading?
I do. I do, as a matter of fact. So if I want to be long in grains, I mean, we have grain markets. We have Canadian rapeseed or canola. We have European rapeseed, European corn, European wheat. We have U.S. corn. We have Brazilian soybean. So I want to look at all those charts. If I'm constructive toward grains, I want to own the grain that's the strongest. I don't want to own the laggard. I want to own the leader. In the case of, I'm long the U.S. dollar against some different currencies right now, and I'm long where I think the U.S. dollar is the strongest. For instance, Singapore. Singapore really hasn't broken out to me yet. It's not as powerful a chart as, let's say, some of the other currencies. So that's what I'm looking for. If I want to be short currencies against the dollar, I want to be short the weakest currency. If I'm long grains, I want to be long the strongest grain. If I'm short interest rate futures, I want to be short the weakest interest rate future.
So between classical chart patterns and relative strength, which would you say comes first for you? Would you look at the relative strength first, then?
I think charts are relative strength to me. All I have to do is look at a chart. I don't need a relative strength metric reduced to a metric number for me to determine relative strength. I just need to look at the chart. What chart is breaking out first? I mean, if we look at Japan, it was Topex. I was for a while very tempted to go to Topex, not the Nikkei, because the Topex was stronger than the Nikkei. Now, there are some reasons I did, and I'm not going to get into. And that was a case where, I wanted to be long the strongest index in Japan. Once I made the conclusion that I wanted to be long Japan, I wanted to be the strongest futures contract in Japan.
Okay, so let's say, for example, let's say you're trading the grains, right? Let's say corn, wheat, soybean, and let's say you determine that corn is the strongest market among all, but it has already moved. And then you might have a potential setup, let's say, in soybeans, but it's not the stronger, maybe it's just around middle tier or the lower tier. Would you still consider trading the breakout on soybean, even though it's not the strongest of that category?
Sure, sure. It's just that I'll probably be long corn before that, and the position in corn will be profitable before I intervene. And that's not an unusual situation for me. That's the case often is, I just look at a chart and maybe I'm long something. An example is I was short the euro currency before I became long the US dollar because the chart broke out first. So I took the short position in the euro currency weeks before I went long the US dollar index. But finally, the US dollar index broke out. It broke out last Friday. And so, but, that was weeks after I had a position on in the euro currency. So I'll trade each chart based on its own merit. Now, there'll be a point at which if I'm still long a dollar position a month from now, I'm not going to take a new signal. I mean, there's a point at which I'm only thinking then about getting out of stuff I got already on. But at least I have the consideration of trading each chart on its own merit. And therefore, if a chart pattern presents itself and is appropriate and kind of meets my criteria, I'll take the trade.
Okay, awesome, right? So Peter, now let's kind of move into the closing section. If you could give advice, or maybe you have great grandchildren, yeah. I mean grandchildren, yeah. Your children is already old, right? Maybe your great grandchildren, right? And you're seeing them at about 18, 19, 20 years old, right? What advice would you give to them?
Get an education into something that you can earn a living in. Don't be a philosophy major. Don't become a history major. I mean, all of those things you major to get a PhD so you can teach. What a wasted life. Uh, Although teachers are valuable, you do a great job teaching. I like to think I try to do a great job teaching. You're a great teacher. So teachers are valuable. But to be a history major to teach history to a bunch of 18-year-olds, that doesn't cut it for me. And so get a job, become an engineer, think about med school. Uh, and I tell my grandkids, don't don't rule out learning to be an electrician. Don't rule out becoming a skilled tradesperson, learning to operate a computer generated lathe machine, building high precision equipment. Don't rule out working with computers and becoming a geek, but get training in something that actually you can make a living in and support your family in. That's the first thing I tell them. I tell them, stay out of debt. Do what you can to stay out of debt. Now, there's certain things we have to be in debt for. When you buy a house, few people can afford the luxury of paying cash for a house. And really few people can afford the luxury of paying cash to buy a car. I mean, so there are certain things you have to take a loan for, and I understand that. But to the degree possible, don't carry a balance on your charge cards. Know where you spend your money. Keep track of where you're spending your money. Not to be a miser, but just to always be apparent how much you're spending on stupid Starbucks coffee, and was it really worth it when you could have gone to McDonald's for 1/5 the price? So, I want to teach him the value of money, right? I want him to know that money doesn't come free. You got to work for it. Your parents had to work for it. You have to work for it. You have to know what it's worth. To know what it's worth, you have to have a value for it. You have to know what its value. It doesn't come out of a printing press. You don't press a button and have your money deposited into your credit card or checking account. So know that. Be honest. Be a hard worker. Have your employees be proud of you and have value in you because you were honest and worked hard. And I would say also there are more things in life to your work. I know people, they live to trade. I have no desire to live to trade. I trade to live. Other aspects that take place in my life outside of the market are far more important to me than than what's happening to the Nikkei in Tokyo today and what's going on in the currency market. I do that to earn a living so that I can enjoy life and be fulfilled in other aspects of my life. Those are far more important to me is what happens in my off time when I'm not dealing with markets, what relationship with my wife, my Christian faith, my relationship with my kids, my friends, what's going on with my activities, my sports activities, because I still try to stay active in some athletic things. So those are the things that are more important to me. I tell them, work to live, don't live to work.
Wow. Thank you so much, Peter. It has been such a pleasure, right, speaking with you for the last 2.5 hours. So, yeah, words can't describe my appreciation, right? We've covered a lot of grounds today. We talked about your personal side of growing up, your trading, diving deep into the individual tactics of, chart patterns and, words of wisdom that, you have, just shared throughout this conversation. So thank you once again, right, for your time, Peter. I really appreciate it. And I'm so happy to finally see you on the screen.
Well, keep doing what you're doing. I've watched you from afar. There's not a lot of people out there that are young people developing their trading abilities, improving it, but also helping other people along the way. I'm familiar that there's a lot of questionable characters out there doing that. And I'm not about to be on any of their podcasts or radio shows. That I knew who you were before I agreed to be on your program because I know I know a little bit about just enough about what you're doing to know that you're somebody that I can have credibility in. So thank you for the education you're providing to people who want to take trading more seriously in their lives.
Thank you, Peter. I appreciate you.
All right. We'll check back again.